It is a privilege to introduce our speakers for today's workshop. Our first speaker is Mohammed Molu. Mohammed Molu is a finance and business management professional with over 45 years of international experience. He has worked in various senior management positions globally, including Canada, Ivory Coast, and the GCC. He has been in the region since 2005 and holds a wealth of experience in budgeting, strategic planning, financial analysis and reporting, cash flow projections, and project management. Over the last 7 years, he has been working as an independent finance and business consultant. Our second speaker today is Aziz Molji. Aziz Molji is an investment professional with over 20 years of private equity and investment banking experience. Aziz's investment banking experience is primarily across North America and Asia, and private equity investing experience is primarily across the emerging markets. Aziz is currently the vice president at Dubai Holdings. He was previously a managing director at Abroad, and his prior experience includes investment banking, mergers and acquisitions, and leverage finance at Goldman Sachs and Merrill Lynch in New York, Hong Kong, and Seoul. Once again, thank you, Mohammed and Aziz, for giving us your valuable time. I will now hand over the floor to our first speaker, Mohammed Molu.
Thank you, Michelle. Good evening and a warm welcome to all the participants. Today's agenda is budgeting and savings. The presentation will be divided into two parts. I will be covering the first part, budgeting. What is a budget? Importance of budgeting. And Aziz will be covering the savings portion and the related topics underneath. Financial literacy. What is financial literacy? Financial literacy is the ability to understand and properly apply financial management skills to ensure effective management of money. It includes the knowledge of making appropriate decisions about personal finance. I would like to underscore the words personal finance in here, including budgeting, investing, insurance, real estate, paying for college, retirement, and tax planning. As you can see, it covers the whole area of one individual's life and the various different aspects that one has to make decisions as they progress in their life. Before I go further, I would like to introduce the concept of what the human life cycle is all about. Human life cycle is basically divided into three phases. It takes your first few years, which is your birth to the educational years that you finish. Then you are in your prime years, which is earning years, and then you go into post-retirement years. Let's kind of look at each phase a little bit more in depth. Let's go to phase one. Education at one time was primary school, secondary school, and first year of college. When you had that, it more or less covered your 22 years of life. But today, education, if you look at the blue numbers underneath, you'll see that it is 0 to 30 years. 0, well, there is early childhood development now. From early childhood development, there is a primary, then the secondary, then the graduate, then the postgraduate, and then you have what you call even doctorate in there. And by the time a child finishes and enters the working cycle, they are anywhere from the 22-year to the 30-year mark, depending on what they've decided to do. Let's go into phase two. That individual who is now finished studying starts his earnings cycle in there. And the moment he or she starts earning cycle, the first thing that comes into play is marriage. Then the next thing after that marriage is going to be childbirth. Now they have to worry about the education of their children. Then there is a thinking about the housing. Then we have got the child's education, And now you, who was a child going through the education, is now taking care of your own children's education. So now you have to start thinking of that. And guess what happens? After that, the child's marriage, and the cycle continues. This is when you reach your peak years, which you are in your 60s to 65. At one time, people considered 60 as a retirement age, 65 and saying, I'm too old. Um, Today, there is no such thing as retirement. What you see as phase three post-retirement years actually goes from years 55 to 80. And when you look at that, uh, people today continue to work well into their 70s. And the question comes in is, why do people actually continue working into their 70s? One of the first things that come into play is maybe they did not save enough for their retirement. Maybe they did not understand budgeting and spend the money without thinking where and how and when it will be required. It could be that they're working because they want to do more pleasure and travel. They want to save for their grandchildren's education. They want to keep themselves mentally active. So retirement is not what it was before. And today, people continue to work, maybe a little bit less, but they continue to work right into their 70s in there. So let's begin. What is a personal budget? A personal budget is really a plan of your monthly financial statement, which is based upon balancing your income inflows against your expenses outflows. The key term in here, balancing income against your expenses. So a budget is then how do you actually prepare budgets? Well, you have to look at your historical data. What do we mean by historical data? You have to look at your previous years and you have to see what source of income were you making? What source of income are you making now? Has it increased? Has it decreased? What kind of expenses were you doing before? What kind of expenses are you doing now? And where are you in it? Are you doing a good balancing act of that or not? A budget should also be adjustable to circumstances as they change. For example, if you're married and now you have a newborn in your family, the budget has to be adjusted accordingly. Or it could be a life, what you call changing instance that could happen into. Um, and that life could be that, okay, fine, there is a death in the family, or anything that can come as a surprise, as an emergency. So what you need to do is you must track your actuals against your budget to know what happened during that period of time. Because if something happened which was a life event, it doesn't mean it's going to repeat every year. Why is a budget important? Well, there is a number of reasons for that. It is an awareness of your actual financial situation to know that are you spending or are you incurring your expenses as you envision them? Now, one of the things that happens is that it is very easy to understand fixed expenses, for example, rent. But if you have variable expense like a telephone bill, which is on pay as you go basis, or if you have your electricity, your water, and if you're not monitoring during the different times or different periods of the year when you will consume high or low, you will not be planning for it well. So this is where the balancing of the income versus the expenses comes in. You have to be knowledgeable, and the only way you can get that knowledge is to go back to the history, to go to understand and find out what kind of spending habits do you have. This will also enable you to check on any unnecessary expenses that were incurred. Sometimes as humans, we are impulsive. We go and tend to go spend money on things in a very different way, and then later on we regret about it. It also tells you one thing, that are you spending more than what you're earning? And if that is the case, then you are incurring debt. And this is one way of minimizing or potential to avoid any debt incurrence or debt accumulation. If you are doing well in your savings, then you need to understand where to deploy your savings and how to deploy your savings. Then you come and you say, okay, fine, do I have contingencies or emergency funds? And if you look at this pandemic period that we have gone over the past 12 months, Each of us, in one way or another, has been impacted by it. And some have required maybe 3 months of emergency money, some have required 6 months, some 9 months, and some still require money today because of loss of jobs or anything that might have transpired or cut in the income in there. If you are saving well again, then you can look at investment opportunities, or you can look at other streams of income to make sure that you are providing stability to you and your family. And that's the last point, which is it gives you a sense of financial security that I'm all right in there. Let's look at why do budgets fail? Well, for most, it is inaccurate budget preparation. In other words, you do not look at how your spending habits have been and you just arbitrarily go and plug in numbers in there. So preparing a family budget without involving the family, many a times, maybe the husband or the wife, they do their own way of budgets, but the point in there is that the one does not know what the other is doing, and many a times there are things that are missed in here. Also, what happens is that there are quarterly or annual payments that are not plugged in the respective months. So if it is a quarterly payment, then you need to make sure that in March, June, September, and December, it picks up in there. And you are not consistently tracking your actual against your budget. This is a very important thing. Having a budget and not tracking your actual against it doesn't make sense, because then you don't know whether you are planning well or not. You're setting unrealistic expectations, and we as humans sometimes are not honest with ourselves. This is very important, that honesty with yourself of what it should be is extremely important. You're living beyond your means, okay? And you have social pressures, and especially in this pandemic time. Some people have done well, some have done extremely bad. And what happens is that the pressure of peer pressure comes into play, and now your budget is out of whack. You tend to then go to your credit cards, bank accounts, and you start spending, and you do not track it accurately. So it leads to inaccurate tracking. You're not utilizing your bank statements or credit card statements to see what you are doing, and thereby not adjusting your budget to see whether those expenses are incurred were really truly required or not required. The next thing we have is a template, the budget template. It's a very simple thing. For those who have answered no, or for those who have answered yes, there is a template. And what it really does is that you put a budget, then every month you compare your actual, and then you see a variance, and it says that, okay, fine. The chances are that unless you had an increase or a decrease in salary, you will not see much of a variance in the income. You will see less of a variance in the fixed kind of expenses. Example, the housing, the car payment, the car insurance, the tuition fees, etc. Where you have a very tight control, and should have one, is where the variable expenses come into play, and those go right in there. Let's look at the different budget positions that we end up with. The one you really don't want to end up with is the deficit budget, where your expenses are more than your income. You're borrowing funds to make your ends meet. This cannot be sustainable for long, and one must reduce expense or increase income. And you should try to avoid or not be in this category at all, shortfall. If you are, certainly help is required, and one should seek help in there. The next category, the balanced budget, where you are earning 100 and you're spending 100. There is no buildup of emergency funds, and one should start reducing expenses or increasing income. And that is so that you can get from that balanced category into the desired category, which is a surplus budget. The surplus budget, what you want is income should be more than expenses. You're able to save for your emergency fund. You're able to put aside funds for your children's higher education. You're able to put funds aside for retirement. And what you want at every month to be happening is that term savings, that you are savings in there. With that, I will hand over to Aziz now. Aziz, thank you.
Great. Thank you very much, Mohammed Molu. So what we will do now is we will spend a little bit of time talking about saving. What does it mean to save? What should you be saving for? And then, some tips around, how to potentially increase your savings. When you think about savings put simply is the difference between what you're earning and what you're spending. As simple as that. And when you think about savings, you're saving for future life events. And we will get into detail for all of that a little later. So just talking about a little bit, what should you be saving for? What is the reason for saving? I mean, you're essentially saving for emergency, and we will talk about, what are some life events that can be classified as emergencies. You're saving for sort of defined future events in your life. One is clearly the education of your kids. Two is when you yourself are going to retire, because when you retire, there will at a minimum be a decrease in your source of income. So you need to save for that. And then there are other life events where there might be critical illnesses, there might be a death in the family, there might be marriage. So there are future events that you need to save for. You also need to potentially save to at least try and secure a property in your home country. I think that's a goal that one should aspire for. You can save to create additional sources of income. When you save and over time, as your savings grow, you can use that to create additional sources of income. This is something that we'll talk about potentially in a later series, but savings can help you create additional sources of income, and savings can help you sort of achieve your long-term financial goals as well. So these are the main reasons for savings. Now we'll go into a little more detail on all of these different categories. Now, what is saving for emergencies? There are potentially two or three emergencies that any of us could face in our lifetime. There could be a debilitating illness that would prevent the bread earner in the family from earning. There could be loss of job for the bread earner in the family. So we all need to be cognizant of saving for emergencies. Now, what is prudent to save for emergencies? I think different financial experts have different opinions. There is a school of thought that says you should be saving a minimum of 3 months and potentially as much as 9 months for emergencies. If you look at today's environment, and if you look at potentially suffering a job loss in today's environment under COVID circumstances, I think all of us know that securing another job potentially takes longer than it would take under normal circumstances. So it's potentially prudent to budget for, to save for at least it taking you 6 months to secure a job. There are also circumstances where you might have to take a job that is paying you less than what you were earning before. So from an emergency perspective, it's sort of prudent to have funds that are categorically savings for emergencies. The second important category of savings is savings for education for your children. That'll be a function of how many children you have, how many years to go until your child or children go to university or college. Where would they go to college or university? How long is college or university where they go? Some programs are 4 years, some programs are 3 years. So all of that is it will be a function that would determine how much you need to save as far as the education for your children are concerned. And we'll give you sort of a working example of this a little later on to bring this to life. Then, of course, as we talked about earlier, there are savings for specific events in a life, putting a down payment on a house, buying a car, marriage. So you all have to consider the timing as well as the cost associated with this and to save for that. And then finally, you have to consider saving for your retirement. What are the variables that you have to consider? And Mohammed Molu spoke about this a little bit earlier. It'll be a function of when you will retire. It'll be a function of where you will retire. It'll be a function of your expenses when you retire. It'll be a function of what benefits post-retirement you get from your company when you retire. Is there end of service? Is there pension? Are there health benefits? It will also be a function of what benefits do you get from your government when you retire. For example, in the US, you get Social Security, you get Medicaid, you get Medicare. All of that will feed into your thinking around how much do you need to save when you retire. So that kind of described the main buckets of savings for you. Here, what we thought is we would walk through a very simple example of if you think about how to budget for saving for your child's education. The example that we are showing you here is you have one child. That child is 10 years away from going to college. Where that child would go to college today, the annual cost of that is $10,000. There are 4 years that the child will have to be in college, and we've taken a simple assumption of 2.5% inflation. So as you can see, your child will go to college in year 11 because there are 10 years for your kid to go to college. The $10,000 that cost to go to college today will be somewhere between $13,000 and $14,000 by the time your child goes to college. And this is on the basis of a simple assumption around inflation. And bear in mind, a lot of universities, the growth in the amount that it costs to go there is actually more than inflation. So now you know that from year 11 to year 14, I will have to spend a total of approximately $50,000 to send my one child to college. I need to start saving for it now. If I make the simple assumption that I need to start saving equally each year over a 13-year period to cover that expense, you need to save $4,000 a year for you to be able to send your child to college for 4 years, 10 years from now. This just gives you that simple example. It also makes a simplistic assumption that you're not making your money grow. You're saving $4,000 a year, but that's not growing. You're not making it grow. You can, of course, by investing in other means, make that money grow as well. But here we've tried to keep the example simple. So why is it important to save? Now saving is a little bit of a mindset shift. It's not about depriving yourself of something. It's about investing in your future. It's about investing in the future of your generations. I think all of us, as we think about savings, we always think about, I want to improve the life of my generations as well. And that motivates us to save. So saving is about investing in your future. We thought we would give you a simple rule of thumb as all of you, vast majority of actually budget. So I think these are rules that you're probably all quite familiar with. But just a rule of thumb is that, try and budget about 70 to 75% of your income for essentials. Try and budget about 10 to 15% for nice to have at a minimum. Hence, try and budget 15 to 20% for savings. But don't make that a static goal. As you go further on in life, as your income hopefully potentially increases, as your wealth hopefully potentially increases, as your sources of income potentially increase that goal. The 15 to 20% saving, financially try and increase that goal over time as well. And then finally, what Mohammed Molu touched on earlier is there's no need to spend for peer pressure. There's no need to spend to keep up appearances. You have to spend within your means so that you are being diligent and practicing financial discipline around saving. I think this we talked about a little bit, try and differentiate between what's essential, what's not essential, food, utilities, education, essentials, non-essential, buying another branded polo shirt, non-essential. So, you have to differentiate between what's essential in life, what's not non-essential. And that will help you create the financial discipline to be able to meet your savings and financial goals. Now, there are two ways of increasing your savings. One is by increasing your income, and two is by decreasing your expenses. Now, how can one increase one's income? Mohammed Molu touched on this earlier. Today, education is not about, getting to a bachelor's degree, and then working and then not thinking about education after that. Today, education is about upskilling yourself consistently over the course of your career. That doesn't necessarily mean getting degree after degree, but it does mean upskilling yourself around specific areas that are beneficial to you in your career and help you in your career advancement. And as you do that, with that upskilling, with strong performance at work, promotions come. With promotion, increase in income comes. So there are ways in which you can increase your income. That's one way. As you save, you will create a pocket of money that will allow you to potentially create other sources of income. That's another way to increase your saving. And then finally, of course, keeping a check on your expenses is a way to increase savings. We touched upon this a bit, but we thought we would give you some basic, kind of tips that all of us are probably well aware of, but just something where, just a reminder and us just keeping an eye out for these things. Simple things like, when you're shopping for groceries, today online shopping, right? Noon.com offers brilliant discounts on buying groceries. So you have to keep your eye out for deals, for potentially shifting to online to kind of create these discounts. Keep a real eye out for your utility bills. Sometimes we are not as focused on our utility bills. There are differences in charges for water, for example, for peak hour rates versus non-peak hour rates. So be careful around that. Always check your phone bills to get a sense of, what are you being charged for. When you have credit card debt, when you don't pay your credit cards on time, there are late payment fees that you'll end up paying. There are, double-digit interest rates that you'll end up paying on that. So if you plan properly, if you're financial discipline, you can minimize that, or you can potentially eliminate that, which is a saving. So these are just some examples for you to kind of think about, how can I, even for things that are essential for me, how can I actually save on things that are essential? And non-essential spending is all about prioritizing. And it's about not prioritizing every month. It's about prioritizing over a 2-month, 3-month, 6-month, 9-month time frame. So you have the chance to course correct in case you go above in certain areas. I think this we mostly touched upon, not paying your bills on time, suffering late payment penalties, suffering interest rates, not doing the simple things of when you go out to eat, not looking at the bill, where sometimes you might be incorrectly charged, not having a clear sense of the fees and charges that your banks are charging you. Impulse buying is something we're all guilty of. That happens. I don't think we can eliminate that, but you can course correct it. If you impulse buy in a certain month, then you can course correct it and not do it for the next 3-4 months. So there are ways of exercising financial discipline that will really help you in achieving your savings goals. Okay, and finally, and Mohammad Molu, please jump in here as well. We thought the key takeaways from the session today is please budget rigorously. Please track your actuals, expenses versus budget. This will give you the opportunity to course correct if you can see that there's an issue with your actual expenditure versus what you've budgeted for. Just have a clear sense of where you need to spend and where you want to spend, so you're able to prioritize the non-essentials versus essentials. But be rigorous around setting yourself a savings goal, and then be rigorous around trying to achieve that goal every month. Have a clear sense of what your assets are, have a clear sense of what your liabilities are, and have a clear sense of how your liabilities, in terms of interest payment, in terms of fees, are actually impacting you. And have a clear sense of what are you saving for. You have to save for emergencies, you have to save for life events, you have to save for retirement. And these are kind of the main categories that you should be saving for. Mohammad Molu, would you add something to that?
Yes, I would like to add one thing, that the budgeting exercise is not something that you should be frightened with. Embrace it. It's a very simple thing to do. Um, Make it a family affair, especially at least the husband and the wife as a spouse, as a starter. This way, you have a meeting of the minds. You are common stakeholders. You know exactly what your family requires rather than one saying, no, this is a priority, another one saying this is a priority instead of two budgets in there. The template that we'll be sending after this webinar, use it. It's a very simple template. The more you use it, the more friendly it is for you. And you know what? Once you start seeing the minuses move to the pluses, believe me or not, there is nothing more uh, kind of gut nice feeling that, oh, we now have moved to the positive side. And once you're on the positive side, then you start feeling that, okay, we can now do this, which could be life-changing event. It could be education in a better institution for your children. You know, everything starts moving up in the positive direction. But if you do not have a picture in front of you, you will never, never, never be able to know whether you are on the correct track or you're off track. That's what I would like to add. I have seen it in my practical life, and I have shared it offline with various individuals. And one thing that I've always insisted that if they want to come and sit with me to discuss anything, I always insist on one thing: husband and wife or the family should be together. And you know what? In the beginning, you might have some differences, but when the differences are sorted out, then everybody is on the same path. That's all I would like to add in here.
I would like to take this opportunity to say a big thank you to Muhammad and Aziz for their time and sharing their knowledge, to all our listeners for attending and making this workshop a success, and the institutions for supporting us. We hope that today's information will assist you in better handling and managing your budget and savings challenges.